All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I apologize again about this morning having to bugger off there a little bit early, so did jump on video and make the trade exit a little bit early there. Won't be the norm. I guess by the time it got to the regular video time, the stock was down 20 cents from where it was. So yeah, a little small difference in the option value, about $100, but nothing that's game changing in terms of the challenge there. So let's go out and take a look here. I'm going to talk a little bit more about Pepsi. Just because I was pretty quick with it here this morning. But before we do that, there are no new entry triggers on the board right now. We have had 7 triggers come in since the challenge started. It's been a good pace of triggers, in terms of just number of triggers that have come in, and it's the pace that, I expect it to be. We haven't been able to trade them all, which, we've talked about, due to earnings or, Netflix, the option value there. But Pepsi's been able to kind of erase that, the missile launch, basically, right, where, Starbucks and Disney, we got dinged out of those due to that missile launch. And then, Pepsi, survived the day where it was announced that tariffs were still going to, exist between the U.S. and China, and was able to make a nice push yesterday, and then a small little push here this morning. So I'm in all cash, now here for the challenge. Challenge is just over, just under 3,400 here. And so, not a ton of progress, nothing to write home about there. But I did something this morning that is contradictory to the algorithm, right? I took the entire position. Instead of selling 40% of it, which would have been 2 contracts, I took the entirety of the position and said, okay, I will look for another opportunity to get back in and give myself some time here for that. Now, that decision was simply due to Pepsi. It had nothing to do with the market, nothing to do with anything else, but had everything to do with Pepsi. And when I look historically at the data on Pepsi, and let me see if we can clean this up a little bit and show you here. There we go. Pepsi can make some very nice runs, right? It can make some very big trends. And this is a stock that last year it was down at $100. Now it's at 140. And if we look at the trends here, it's similar to prior years, right? The upward trend, when we look at this upward trend right here, it was really only 3 or 4 days that made it, right? This wasn't a, hey, let's just go up every day for 7 days. Right here, right? 1, 2, 3, 4, 5, 6 days that made that trend, and afterwards, pretty flat. Here, 2 days. Here, 3 days, right? Here, we have 6 days. This isn't, and even here, it's a 2-day thing, right? This isn't a stock that has put on massive gains without consolidations. And that is the nature of Pepsi. And I mentioned this morning that, yes, Pepsi's breaking out, and I do expect it to go higher and all of that. But when we look at the historical nature of Pepsi, yes, to move 2 average true ranges after a signal, the odds are good. And Pepsi has done very well with that. To move 4 average true ranges or 6 average true ranges, very low probability, very low chance with the ATR method. Now, if it was going to be something we buy and hold for a month and a half, yeah, the odds are significantly greater. But something where we have a 3-day time stop on it, no, the odds are very slim. And what happens is, yeah, you get the jump, then you get time stopped, and then, jumps again, and it's out. So I made the decision because of the way Pepsi is traded historically, because of how it's modeled with the algorithm, to take it all and move on. Now, I also give myself the opportunity, as I mentioned, to say, hey, I'll give it 2 days till I can maybe get back in. And I do that for a big reason. And that is because there's just not a lot of stuff that has a great chance of triggering right here, right now. So I don't want to be, I don't want to be in the lurch here with Pepsi. If it gets a nice little pullback, an opportunity to get back in that isn't a pure crossover. But, I'll err on the side of extreme caution there with it. I won't be, super aggressive there with it. But decided to take it early in the challenge, got us into the green, so changes how much we can put on the next signals that come in. And played the odds that way with it. And what does Pepsi do from here? I don't know, right? It's not like I sit there and I can answer and say, well, what's it going to do tomorrow? I don't know. What's it going to do this afternoon? I don't know, right? The stock's overbought in the short run, but it's breaking out on a daily basis, right? And so you're caught in that mix between a breakout and an overbought, type of position. And, it's one of those where, hey, the day we entered it, it was overbought on shorter term charts, right? And on the daily chart had a nice signal. So, that mix is always there, when it comes to stocks and technicals here. Ultimately, I do expect Pepsi to go higher, but, this is also something that does have earnings up and coming. So do have to, pay attention to that. And then their counterpart, right? Coca-Cola has earnings up and coming here, as well. So, they're still middle February, so we can still play it. It doesn't render them unplayable like an IBM signal would render IBM right now, or the options would render IBM. But anyway, so I'm out of Pepsi, moving on. And, if it does give a nice little re-entry point, then I will look to take it, set up the ATR method, and, and go. And by nice little re-entry point, I'm kind of talking about, a little pullback today, then maybe a pullback in about the 137.5 area tomorrow with some volume suggesting that, hey, it's just a small minor pullback. Then maybe I'll put 1,000 in and go. But would model it there with the ATR method, and that would be conditional on the 3 and the 7 day moving averages continuing to be bullish here for it. Okay, you won't see me do that a lot. In fact, very rarely will you see me do that. But with Pepsi, I thought this is the best way to go about it, given where the challenge is and given what the odds are. Because if you remember, we talked about this a number of times with the ATR method. It's not that selling 40% of a profitable trade after a 2-8 or 40% of a trade after a 2 ATR move is the move that is right the majority of the time. It's the most profitable move, but that getting from 2 ATRs to 4 ATRs, the probabilities are less, right? In general, they're less. Now, for different stocks, it's different. For Pepsi, it's very low. So, just given where we are, and not worth the, I just deemed it wasn't worth me taking the risk, and so I didn't. All right, so that's Pepsi, and, moving on. Moving on there. I wish there was a new signal to put some cash into play. We do have some crossovers happening. FCX on the downside, but not a signal, not even close to a signal there with it. It was an upside crossover 2 days ago, and it's just in a pretty hefty consolidation. On the upside, we have American Airlines, General Motors, Gold, Barrick Gold, MGM, and Verizon. And none of these are signals. If we come in and chart them, you'll see there's a common thread with them. American Airlines, you'll notice the Stoke 39.1 well below 50. The stock trading below the 20-day moving average as well, which isn't, a necessity, but we often don't see signals on stocks, trading below their 20. If you go back and you look at Pepsi, this is one that, it was very close on that 20, but on the Stoke 39.1 was above that 50 level, and that's what we will typically see there. So nothing there with American Airlines. General Motors, same kind of deal as American in terms of just we're talking about well below the 20. We're talking about the Stoke 39.1 below 50. A very, very low chance of triggering when those two things happen. And yeah, those two things aren't in the algorithm, but they're just the visual way for me to be able to show it there. So MGM, this is one that is a little different. Is trading up near the upside of the range and everything. We saw an upside crossover on it a few days ago that didn't trigger, but not getting a trigger on it here today either. Consolidation risk component is, and I was a little surprised at that, but is a little bit high here. The options are tradable. Priced them out. They're not bad. I think it's a very interesting opportunity there with MGM, but not a trigger. So anyway, that's where things are. So I'll wait for the next trigger, and we'll go after it as they come in. Now I want to talk a little bit about gold, and this is something that you've heard me talk about before. And we've talked about we've played gold a few times in the challenge. I've talked about my positioning in gold and everything else there. And so I want to kind of show a couple things here with gold. First, the seasonality chart over the last 10 years. You can see January by far the best month for gold in terms of being up. Now, it is counting this year already, so if we take out this year, it's exactly the same as August in terms of the number of times it's up and in terms of the average monthly gain. What do we know about January and August over the last 10 years? Well, these have been pullback months in the market. Right, that's what they've been. They've been pullback months, so okay, how valid is it? Well, any type of seasonality, there's some validity, but it's not a be-all, end-all. One of my favorite things when it comes to gold, and one of the things that I look at the most is this. All right, now what are these squiggly lines? Well, our top line here is the gold miner ETF, so it's GDX. Okay. Our bottom line is gold, GLD. Okay. So we have the performance of gold and the gold miners together. And you'll notice over the last year, gold is up 20%, the gold miners are up 40%. What does that mean? Well, historically, when gold miners outperform gold, we see both continue to go higher. When gold miners lag gold, we see both kind of turn around and go lower. That's the general nature there. So looking at this, what would I say? Well, we're probably going to see gold go higher from here, right? We're probably going to see gold go higher. But there's something here, right? And back when we traded gold for the challenge, you'll see that the gold miners outperformed gold significantly right back here in June. And then look at what happened, right? They both continued higher, the GDX to a much greater degree. But then we got this period where gold, we saw this in September, and this chart down here below just tells us what's outperforming. If it's going up, we have GLD outperforming. If it's going down, we have GDX outperforming. And we saw this push here in September where gold outperformed the gold miners. And since then, we have seen both of them just kind of consolidate, right? Just kind of consolidate here. Now, we had a push up in gold in the GDX here at the end of December and beginning of January. And what happened? Well, at the beginning there, we saw the gold miners outperform, which was very positive. In December, gold miners outperforming. Okay, probably going to be pretty bullish. But then as we got into January, we started seeing gold outperform and the miners lag. That to me is very concerning. That to me says, you know what? Are we going to see a short-term pullback come into play? Is that going to happen? And is one of the reasons why I talked about me trimming my GLD position in a significant way. Now, over the last 2 days, we have the gold miners outperforming gold, and pretty nicely. But in terms of the entirety of the performances here, in the long run, the GDX versus GLD performance is very bullish. In the short run, it's pretty darn mixed, and one that I think over the course of this last January, we have seen gold outperform the gold miners, so it does kind of give me pause there with gold, and just say, all right, I'll wait for a little bit more of a pullback, or wait for them both to start going up and see the miners outperforming to a greater degree, and this is one of the best ways that I have ever seen to really look at gold and to assess, what is ultimately going to happen. So, in terms of very long-term plays on gold, to me, they're very bullish, when it comes down to it. In the shorter term, there's still some consolidation and pullback risk that's, absolutely on the table there for it. All right. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.